Benefits of decentralization. Top management freed to concentrate on strategy. Lower-level decisions often based on better operational decisions. Lower-level managers can respond quickly to customers. Lower-level managers gain experience in decision-making. Increases motivation, resulting in increased job satisfaction and retention. Disadvantages of decentralization. Lower-level managers may make decisions without seeing the big picture. May be a lack of coordination among autonomous managers. Lower-level managers' objectives may not be those of the organization. May be difficult to spread innovative ideas in the organization. Cost, profit, and investment centers are all known as responsibility centers. A cost center is a segment whose manager has control over costs but not over revenue or investment funds. A profit center is a segment whose manager has control over both costs and revenues but no control over investment funds. An investment center is a segment whose manager has control over costs, revenues, and investments in operating assets. Learning Objective 1 is to compute return on investment, ROI, and show how changes in sales, expenses, and assets affect ROI. ROI equals net operating income divided by average operating assets. Net operating income is income before interest and taxes, EBIT. Average operating assets include cash, accounts receivable, inventory, plant and equipment, and other productive assets. Most companies use the net book value, acquisition cost less accumulated depreciation, of depreciable assets to calculate average operating assets. DuPont pioneered the use of ROI and recognized the importance of looking at the components of ROI, namely margin and turnover. Margin equals net operating income divided by sales. It is improved by increasing sales or reducing operating expenses. Turnover equals sales divided by average operating assets. ROI may be computed by multiplying margin times turnover. Regal Company reports net operating income of $30,000, average operating assets of $200,000, sales of $500,000, and operating expenses of $470,000. What is Regal Company's ROI? Regal's margin is 6% and its turnover is 2.5, making the current ROI 15%. Assume that Regal's manager invests $30,000 in a piece of equipment that increases sales by $35,000 while increasing operating expenses by $15,000. Let's calculate the new ROI. After the investment, Regal's new margin is 9.35% and its new turnover is 2.33, which increases the ROI from 15% to 21.8%. In the absence of a balanced scorecard, management may not know how to increase ROI. Managers often inherit many committed costs over which they have no control. Managers evaluated on ROI may reject profitable investment opportunities. Learning Objective 2 is to compute residual income and understand its strengths and weaknesses. Residual income is the net operating income above some minimum required return on operating assets. Residual income equals net operating income minus average operating assets times the minimum required rate of return. This computation differs from ROI. ROI measures net operating income earned relative to the investment in average operating assets. Residual income measures net operating income earned less the minimum required return on average operating assets. The retail division of Zephyr Incorporated has average operating assets of $100,000 and is required to earn a return of 20% on these assets. In the current period, the division earns $30,000. Let's calculate residual income. The residual income of $10,000 is computed by subtracting the minimum required return of $20,000 from the actual income of $30,000. Residual income encourages managers to make profitable investments that would be rejected by managers using ROI. Redmond Awnings, a division of Wrap-Up Corporation, has a net operating income of $60,000 and average operating assets of $300,000. The required rate of return for the company is 15%. What is the division's ROI? The ROI is equal to $60,000 divided by $300,000, or 20%. If the manager of the division is evaluated based on ROI, will she want to make an investment of $100,000 that would generate additional net operating income of $18,000 per year? No, she would not want to invest in this project because it would reduce her division's ROI from 20% to 19.5%. The company's required rate of return is 15%. Would the company want the manager to make an investment of $100,000 that would generate additional operating income of $18,000 per year? Yes, the company would want the manager to invest in this project because the return on the investment of 18% exceeds the minimum required rate of return. Using the same facts, what is the division's residual income? The required return is 15% of $300,000, or $45,000, making the residual income $15,000. If the manager of the Redmond Awnings division is evaluated based on residual income, will she want to make an investment of $100,000 that would generate additional net operating income of $18,000 per year? Yes, she would want to invest in this project because it will increase the division's residual income by $3,000. The residual income approach has one major disadvantage. It cannot be used to compare the performance of divisions of different sizes. Recall that the retail division of Zephyr had average operating assets of $100,000, a minimum required rate of return of 20%, net operating income of $30,000, and residual income of $10,000. Assume the wholesale division of Zephyr had average operating assets of $1 million, a minimum required rate of return of 20%, net operating income of $220,000, and residual income of $20,000. Residual income numbers suggest the wholesale division outperformed the retail division because its residual income is $10,000 higher. However, the retail division earned an ROI of 30% compared to an ROI of 22% for the wholesale division. The wholesale division's residual income is larger than the retail division simply because it is a bigger division. Learning Objective 3 is to compute throughput time, delivery cycle time, and manufacturing cycle efficiency, MCE. Delivery cycle time is the time from when a customer order is received to when goods are shipped. The time from when the order is received until production is started is wait time. The start of production until the time goods are shipped is throughput time. It includes process time, inspection time, move time, and queue time. Process time is the only value-added time. Manufacturing cycle efficiency, MCE, equals value-added time divided by manufacturing cycle, or throughput time. An MCE less than 1 indicates that non-value-added time is present in the production process. Given the listed information, what is the throughput time? Throughput time is the sum of process time, inspection time, move time, and queue time, for a total of 10.4 days. Given the same information, what is the delivery cycle time? Delivery cycle time is wait time plus throughput time, or 13.4 days. What is the manufacturing cycle efficiency? Manufacturing cycle efficiency is value-added time divided by throughput time, or 1.9%. Learning Objective 4 is to understand how to construct and use a balanced scorecard. Using a balanced scorecard, management translates its strategy into performance measures that employees understand and influence. Performance measures are divided into 4 groups: financial, customer, internal business processes, and learning and growth. The balanced scorecard starts with vision and strategy. It considers the company's learning and growth and internal business processes. These, in turn, are the basis of performance measures that also recognize the importance of customers and financial performance and goals. The balanced scorecard relies on non-financial measures in addition to financial measures for 2 reasons. 1. Financial measures are lag indicators that summarize the results of past actions. Non-financial measures are leading indicators of future financial performance. 2. Top managers are ordinarily responsible for financial performance measures, not lower-level managers. Non-financial measures are more likely to be understood and controlled by lower-level managers. The entire organization should have an overall balanced scorecard. Each individual should have a personal balanced scorecard. A personal scorecard should contain measures that can be influenced by the individual being evaluated and that support the measures in the overall balanced scorecard. A balanced scorecard should have measures that are linked together on a cause and effect basis. Each link can be read as a hypothesis in the form of, if we improve one performance measure, then another desired performance measure will improve. The balanced scorecard lays out concrete actions to attain desired outcomes. Incentive compensation should be linked to balanced scorecard performance measures. Assume that Jaguar pursues a strategy as shown on this slide. If employee skills in installing options and the number of options available increases, then the time to install option decreases and customer satisfaction with options increases. If customer satisfaction with options available increases, the number of cars sold will increase. If the time to install an option decreases and the customer satisfaction with options available increases, then the contribution per car increases. If the number of cars sold and contribution per car increases, profit will increase. End of Chapter 10.